Thank you very much for the introduction. So we mentioned Q1. It's a little more forward-looking than that, fortunately for you guys. I mean, Q1's past us, and I know every day in your lives is what happened tomorrow, not yesterday. So try to keep it on the trend cycle for that. So yes, everyone heard my title. I named myself. I think I have to redo it next time. It's a little long. But we'll go over some key areas of the marketplace. So stemming from what we see in the economy, how that facilitates our residual value forecasting, and then going into the new used car markets, and an outlook on electrification. Please no one hold me to what I'm saying today, but it's what's out there right now as we see that changing kind of quickly. And then the all-important retained values and where our bread and butter is as a company for Canadian Black Book. We stem mostly on wholesale values. Obviously, everyone follows us for that. But residual values and insights in what's coming down the line for trend analysis. So a lot of data right before lunch. Hopefully everybody's ready for this. At least you're hungry, so that makes you more alert instead of sleepy afterwards. So I think that's a benefit. But going over the key variables here, this is kind of what we look at on a residual value forecasting basis, sort of understanding what's happening in the wholesale market, understanding what's happening macroeconomically in Canada. And for Q1, and going forward from that, obviously, we've had a bit of an ambiguous first quarter where there's nothing that defined for us to hold on to. And I know that's kind of not the best news to hear, but things are moving in the right direction at least. They're ebbing and flowing, obviously, going to and from. But we hold accountable these variables to sort of influence what we see on the longer term trend for forecasting, obviously, and stemming first with the exchange rate in Canada, which has been moving back and forth, as I said before, but at 73.8 cents Canadian as of the end of Q1, we know that there's a lot of interest in Canadian cars in open auction lanes. It makes shopping for vehicles that much more difficult for yourselves with US operators coming here and taking inventory. We saw the height of this around 2022 and 2021 during the pandemic, but now it's calmed down. But when you have an exchange rate like this, you're still sort of battling with one hand tied behind your back if you have a lot of US traffic in the auction lanes. So that's something we predominantly look for as retained values high and looks to stay consistently high for a little bit longer. Outside of that, we concentrate on affordability being a real problem in North America, let alone Canada. And what we're seeing now is, when we're tying things to a high interest rate and we're battling inflationary action, the Bank of Canada is holding that rate. We expect it to start to come down, maybe 0.25, maybe half a percentage point for the close of this year, but that's to be seen. Obviously, inflation's ticking down. We're now at 2.7%. Apologies for the outdated slide, but I wanted to make it Q1 centric as we see the trend analysis here. And in battling with affordability, we know that a lot of customers are seeing new car supply come to the market. That's adding a little of a hampering effect on the used car supply, which we'll get into a little further. But when you look at the total population growth of almost 1.3 million people in Canada last year, you see that that's kind of changing things. Not all of them are permanent residents. There will be temporary for the majority. But ultimately, this is a trend that we're seeing that will obviously keep some sort of demand readily available in the marketplace going forward. We know that new cars are in high demand still, even now that supply is coming back to the market. And then with the additional unemployment rate sort of ticking up because it just can't outpace population growth, we're looking at things on the good side for retained value stemming with that demand sort of being bolstered up by population. So that's kind of the overlay of what we're looking at from a valuation standpoint. And it's giving us a good sense that retained values shouldn't necessarily fall down the way they have been in tandem with the wholesale action we saw as of the last quarter of 2023. We haven't seen that hold true for 2024 so far, which is what we anticipated initially. And all sorts of good momentum going into 24 in terms of new sales volume. So going into the new car market, we see what we've been, adjusting to on a on a sales basis year over year, 11% up last year. We're anticipating another 9%. I'll get out of the way for that one. Another 9% this year, hovering around 1.8 million. Might have a downtick as we see sales slow down a little bit as of March and April, although the first quarter was very strong. We're anticipating this trend to hold true. The makeup of the market's going to change, and we're anticipating getting back to almost and maybe a little bit of a 2 million vehicle market in the short term. So by 2026, 2027, we'll hopefully get to that point. Hopefully new car supply keeps moving the way it has been, and think about the makeup of cars at that point in time. A lot of investments going into battery electrics, maybe plug-ins. We've been hearing strategies changing on the planning side for OEMs. So that might make up a lot of what you're selling in the showroom. I mean, some brands are making or selling that powertrain more avidly than others right now. So that might be the more predominant trend going forward in the sales floor. But as we move forward from that, we can't really ignore what it's done to our used supply channels. And what it's done over time is eroded those. We can't ignore, the last 3-4 years of poorer new sales volume. It facilitates into the used car supply channels through the rental market, through the consumer market, any other market you speak to, it's going to affect in some way, shape, or form the same impact. And we work off of a predominant 48-month lease and return to market sales channel. We're still that way, even though lease terms and finance terms are getting a little bit longer these days to offset affordability issues. But ultimately, we see those vehicles sold today that are coming back in 4 years are coming in around that 2027, 2028 mark. And that's where we see used supply start to taper back up, which is really good. It's going to, again, put a little bit of more stress on retention values. But in tandem with the demand and the makeup of the market that we're going to see, this is going to be an interesting chart to see evolve over time. Now, talking to that point, what we saw maybe 6 to 9 months ago, this chart was a little bit different. We saw less volume coming in 2025 and 2026. So the valley was actually not as shallow as you're seeing today. But this is a good sign. A lot of OEMs are strategizing around shorter term lease for the high residuals that we're seeing in the market. So they're strategizing behind that and planning to bring customers back into the showrooms a little bit quicker, help that supply channel move forward in a better fashion than initially was anticipated. But we're still seeing not a full recovery until that new sales volume is realized, and that's going to happen a little further down the road. So an important note to make is how is that inventory of used supply going to look as we move forward to the end of the decade. And I pulled this out from our retail listings data and sort of used a comparison to what we look on a forecasting basis. And what we can see is that right now we're about 2% BEV, full BEV, not plug-in, not hybrid, full BEV share of the used space, 98% ICEs or internal combustion engines. So as this moves forward, we're going to see all those new car EVs that are coming to the market and being leased now with more lease programs out there really come into effect, that it's going to transition into about a 2,300 percentage point gain over the next little while. And what we're seeing is that it's going to be an 80-20 fix about the 2030 timeframe. So if you're not looking at remarketing these vehicles yet, if you're not getting plans in place, talking to your OEM and understanding what their propensity is to service these vehicles and balance the battery and get them ready for the next customer, and that customer can have confidence in purchasing a used EV, mention affordability once again, this will be the first place they go to if they're looking to get into an EV, can't afford it on the new car side. You're going to have, it's going from, that 2% represents 15,000 vehicles today. In 2030, that 22% represents 368,000 vehicles. So that's the kind of buildup we're seeing over time. And if you're not able to service, able to sell those vehicles properly, educate your customers behind what this brings to the table for them, you're going to be stuck with a lot of inventory you can't sell. And that's going to be a pretty big issue. We're going to have more incentives coming, and we all know what those do to residual value and retention. So some key points here that I want to sort of hit home on because it's quite important. And this is not necessarily untrue. This is a forecast, but you can see the way the ball is moving, and it's not really going to stop its direction. It might slow down, but it's not going to stop. Now, on the retail price standpoint, I'm a little more current. As we're looking at Q1 and what's happening now in the marketplace, we've seen a slowdown on the retail side. Obviously, everyone's seen the wholesale side go a little bit sideways, and those values depicted what happens in the retail sense of things usually. But retail prices had been sticky, and up until the start of Q4 2023, they were at that peak there, circled by that red oval there. And that amounted to the decline of about $2,200 in value on average for the average vehicle, or about 6% of its value on the retail side. And it's still declining as those vehicles have trouble moving. Now, if you're looking at prices on the new versus the used side, we're seeing just under $60,000 for the average new vehicle out there, which is good, better than it was, and $35,500 for the used vehicles. If you break that open by body style, you can see what that depicts. And we're seeing about 53% retention on the average car, 65% retention on the average SUV and truck. That's all the entire market. So there's highs and lows there's obviously. But it's a key point to make that you need to shop, you need to get that vehicle, remarket it quickly, move it out, because that value is starting to come down. So on the electric side of things, as we change pace here, we all kind of know these numbers, but it's good to talk them out loud and understand where we're going as a market in Canada. EV adoption has surpassed 10% annually for the first time. That's a trend that's going to move forward, even though there's not the sentiment we once had for EVs in Canada. It's still moving that direction. I think what's most important here is to see how ICEs have declined. So they were 81.5% of the marketplace. In 2022, they fell to 77, and they will continue to fall. The missing piece here is hybrids. So you're seeing plugins, you're seeing BEVs as part of that ZEV number there, but hybrids are making up more and more of the volume in today's market, and they're taking that directly from ICEs. So what we're seeing by 2026, anticipate about 27% of share on the new vehicle registration standpoint. 2% makes up the plugins. 25 makes up the BEVs. That's subject to change, obviously, with the strategies at play with OEMs today and what we have yet to see. But as we look at this from a standpoint of rebates and incentives in Canada, the makeup is also going to change. We've seen mandates, or not mandates, excuse me, but Manitoba's bringing in a $4,000 new EV rebate. I think that's starting in July. And Quebec's winding theirs down. So the makeup of this is still, the government has their finger on the lever here and twisting things to make the picture a little bit different for us, making it that much more difficult to analyze, obviously. But with this sort of mix-up, we might have a little more of a balanced scenario for the rest of the market going forward for BEVs, which is really interesting as we hope other provinces get up to speed and build the infrastructure as they have in British Columbia and Quebec. To the point that they have, even though it's not necessarily sufficient enough at this point, it's moving in the right direction. So this is a little bit more of a global scale of things. This is showing you just what's coming down the line, and our little nomenclature there for all the segments I can talk to, give you a little bit more of the nomenclature there for all these little segments. But what's important here is that we're going to see about 242 new vehicles globally. Not everything's coming to North America, but at least you get a sense of that size and entrance of vehicles into Canada or into the global scale of things. 69% of those are going to be either a SUV, a truck, or a van. And that's kind of what you've been hearing, hopefully, from your customers if you're talking to them about EVs. They might not have the EV there for them yet, dependent on brand. A lot of people have gotten into passenger cars. That's not necessarily what's selling in today's market traditionally. As we see that change, we're organically an 86% volume of light trucks in sort of last year's market. We can assume that's probably going to tick up, maybe even a little more than that this year. So when you're looking at that, also coming for the EV portion of things, you can see by segment here what's moving and shaking. So I've separated this out to give you an idea of what's in 2024 and what's still to come for the rest of the decade. And if we focus on some key segments here, pickup trucks are all the rage, but there's no small pickup trucks. SPT, by the way, on the right-hand side. for, sorry? It's a full BEV? That's what this slide's about. It's full BEV, not hybrid, not plug-in. But your point is good. That's a very hot, or it was maybe, a hot pickup truck to pick up. That's a bad sentence. But anyways, it's good to bring that to light because that's a key component of how we're making this shift. But small pickup trucks don't make up any part of the market. But by 2030, we're going to have 10 of them. Probably most of them here too. So we've already seen the news from BYD. Hopefully you have. They're bringing one, a plug-in, to your point, to the other market in Mexico. They didn't say if it's coming to Canada or North America yet, but you can figure out what's going to happen soon. So you're looking at a segment like small pickup trucks that's in its infancy. What's going to happen to retention, residual value in a segment where there's 1, 2 players there? Look at, not to call out any names, but I have to, the EV9 from Kia. It's a mid-size SUV. It's playing in a market where there's only 6 of them, and I think they're all luxury. So when you're looking at 18 still to come for the rest of the decade, and you have a heavy hitter on the mainstream side playing by itself, essentially, what do you think is going to happen for retention on that vehicle front at the start of its life cycle anyways? This will evolve. But that sort of thing is what we're looking at to see where retention, residual values can be bolstered up and what we expect to happen in the EV space as we get these vehicles that we know customers want to buy. So moving on to the value retention trend of things, sort of what we do day to day. Looking at the overall, we obviously like to compete with the US or see what the US is doing at least. And the fluctuations from this graph show us that we're not necessarily, even keel with the United States, but we're definitely moving the way that they're moving as a byproduct of how large that market is. Now, I mentioned population growth. We're now over 40 million people in Canada. We're not necessarily 1/10 of the US anymore, which is good. We'll have hopefully more inventory coming to our market in the near future, but that's still to be confirmed. But when you're looking at this, you're seeing that, yes, we're coming down. On the right-hand side of this graph, you're seeing both markets in a pretty significant trend downwards on wholesale price. And what you're looking at here is retention. So that's the wholesale price. We're looking at residuals. We're looking forward-looking. But right now, for retention, U.S. is down almost 14% year over year. We're only down 9%. It's significant, but look at how high we had to climb to come back 10% and still be above things. I mean, that speaks volumes. We still haven't gotten out of this situation. There's still a lot of retention to go. Not saying that's going to be the case immediately for us, but when you're looking at this, we have a benchmark back in 2005. That's when this index started. And that's kind of what you look at the 100% mark. We're well above that still with all the decline we've already seen. So there's still more to go. And this is kind of the way we're going to facilitate that movement over the next few years. So yes, you can see that this has come down steadily from 2022, but there's actions on the wholesale side that have facilitated that we don't expect to continue in the fashion it has. Now, the proper way to read this graph, it gets a little confusing for me at times, so I might as well explain it for everybody else in the room. But we're looking at the average 4-year-old vehicle in the marketplace. Back in 2022, it retained 68% of its original value, and you move forward from there. So we're at 58% right now in 2024. That average is growing. It's probably going to come down a little bit too. We're in April published, as you can see. May hasn't necessarily come out just yet. But we're going to lose about 10% over the next 4 years from this point on. By year, that's not very much. Now, this is a projection, of course, so it's subject to change. But when you're looking at that kind of slow degradation of value, we're not going to have, or we're not anticipated to have, a quarter like we did in the last quarter of 2023 on wholesale. And a lot of these positive and negative factors are the key to what we're seeing in the marketplace, holding this retention up over time. So we're seeing, still a lot of leases not returning to the marketplace. That's suppressing that used supply that we visited earlier. We can use all the pull-ahead programs we want, but if the cars are still expensive, we're not going to get many vehicles or many buyers back to the the dealership and actually repurchase something. Or maybe we will, and we'll have to elongate that term, as we said before. As well, we're looking at new car prices high now and staying high over the course of time. I don't think that trend is going to step backwards, especially with the entrance of more EVs in the market. So these are the kinds of things we're looking at on a case-by-case basis. That's influencing consumer habits. So consumers are preferring to service their vehicles more. Hopefully that's helping everybody in the room as well. But we're looking at most average Canadians driving a shorter distance. These vehicles are not aging the same way that they did, 5, 10 years ago. When you're driving 17, 18,000 kilometers a year on average now, as opposed to 24,000, which we're all tying our lease-based residuals off of, it's a little bit different. And we're looking at this to change as well. On the negative side, we're seeing new car production levels that are normalized, but without that moving at the rate it needs to, incentives have been moving as well in that fashion up. And not across the board for every manufacturer, obviously in the same scale, but the common offenders are back there, and just about everyone's reintroduced these things to sort of incentivize not only the short-term lease rates, but rates in general. And with that, offsets retained value over time. As well, we have to mention fuel taxation and the incline on gas prices. That's going to affect ICEs predominantly, but we've also had diminishing interest on BEVs. I think that's more of a short term as we worry about the infrastructure and whether it's going to develop at the rate we need it to. Obviously, today it's not. But we're going to hopefully improve that over time, improve adoption over time, get the vehicles out there that you need or that consumers want to buy, and move that forward in the way that it should be moving forward for us to all move into the next generation of this marketplace. Now, interesting note as we separate these two markets apart for retention, same metric here, but separated, by BEV and then ICE. As we forecast this, we can see that over time, we've narrowed the gap for BEVs. Obviously, there's been more vehicles out there. And to my point, it's really facilitated the adoption rate moving forward because now those vehicles are out there that people can buy, can drive more than 200 kilometers in distance, right? So we're at a point in time now where we're really reliant on the infrastructure, on the vehicle availability out there and what's out there that fits into consumers' lives. And we expect that to improve. And that's why you can see that compared with the ICE value retention, EVs are kind of bolstered up by a lot of new entrants into the market. They're going to be the right stuff at the right time, maybe not the right time, but if infrastructure develops in the capacity we need it to, it is the right time. So with that in mind, it stays kind of level over the course of time, whereas ICEs become a little more weak in comparison. And that's kind of where we expect this part of the market to go over time. It's going to eradicate some of that gap in retention. You can hopefully get those remarketing programs in place, certify these vehicles possibly, and really make this a key selling point rather than a worry getting into a BEV, a battery electric vehicle, and also the plugins out there too. So that's all I had for you. I know it's a lot of data right before lunch. Thank you for your attention, and I'll be around for questions afterwards.